So that's the 330 target. We make sure nothing's in the way that's generated. And we've been referring to this breakout as having occurred well down here. There was actually a squeeze within a squeeze. So we've been taking leverage long trades for quite some long time, seeing the volume climb. This is a break you've run here. The big journey, the next rest point for us is just before the $100 mark.
If we were to get a couple of big days, then we might get to 4,000 gold, $50 silver, get our minor 5 to 10 day pullback. But I kind of think that they're probably going to go through those levels. And part of the reason I think that's going to happen is the last 4 breakouts from the consolidations.
Some market technicians with long-term perspectives have published much higher targets. Based on quarterly chart patterns and historical analogs, silver's long-term potential could be significantly higher than current consensus estimates, especially if global monetary conditions continue to deteriorate. When adjusted for inflation, gold's previous all-time high analysis from 1980 would equate to approximately 9,000 to 10,000 inches today's dollars. This historical comparison provides context for why many analysts believe the current gold and silver bull market prediction has substantial room to run before reaching truly bubble-like conditions. Analysts FrancisHunt and GarySavage both foresee significant upside for gold and silver, although they differ in their approach. On silver, the optimism is extreme. GarySavage predicts that silver will test and surpass $50, with only a brief pullback before the next explosive move. In his aggressive forecast, Hunt projects a stunning long-term target of nearly $330 based on his proprietary model. He warns that silver's real breakout has not even started. Recent moves will trigger a face-melting rally. Looking at fundamentals, Savage envisions gold reaching $10,000, describing it as a piece of cake, despite likely pullbacks. According to him, the bull market could persist for another 2 to 3 years before entering its parabolic phase. Gold futures rose to an all-time high of $4,014 an ounce on Tuesday morning. The precious metal, which investors typically favor as a hedge against inflation or stock market downturns, has gained approximately 50% this year, outperforming most stocks in the S&P 500. In his bullish analysis, FrancisHunt argues you must ignore traditional indicators like RSI, calling them lagging and misleading distractions. The gold rally isn't a technical phenomenon. It's a fundamental, anti-dollar, anti-fiat trade driven entirely by collapsing confidence in paper assets. Before we dive into FrancisHunt and GarySavage's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I'm in agreement that we are, on the macro timeframes, going a lot higher on both metals. I personally, having been a technical analyst for a long time, I don't utilize RSIs, overboughts, backdays, or anything, which for many is deemed a foundation of technical analysis. These are mathematical formulas that have been applied in a lagging manner to price data. There are some indicators that lean on a bit of volume data as well, and they are more interesting to me, and I separate them from my condemnation that I'm going to give now. But an RSI, if you trade on an RSI, let's just say NVIDIA over the last 4 or 5 years, you would have been probably on a monthly, a big time frame chart, you probably would have been on the high side of the RSI limits and for the entire period, whilst this thing doubled again, doubled. So I actually think that RSI is completely and lacks merit as indicator generally, never mind for bull markets. But it's doubly destructive in bull markets because it has people sell too soon. So we see much higher metals. Many people think that we're already done 3,800. You are going to have rest periods, as Gary alluded to in his piece of cake but pullbacks clarification, and I agree with that. I think we could even be on one right now, but that is more for the that's more for the journey path on a much higher move generally. So we have non-farm payrolls on Friday, my apologies. By the way, we had a terrible ADP number on the macroeconomics, so that's just not technical comments. but that typically is supportive because people think greater rate cuts, etc., etc. But I do think there is a key support level for the dollar where it'll get a rally before probably trading lower later. And there's been immense dollar weakness behind this gold trade. So there is a dual effect of people not buying treasuries and dollars and choosing to buy gold, and the appreciation of gold and the depreciation of treasuries. It's kind of you're playing a football match against one of your biggest rivals for the title. You score 3 goals, they go -3 on gold difference. You go +3. You not only are you getting your 3 points for winning the game, but you're also doing damage to one of your biggest rivals. The gold trade is the anti-dollar UST trade first and foremost, and an anti-fiat trade generally in the larger set. And we are far earlier in the innings when we look at miners versus the Dow Jones generally, and a lot of these things have barely really got started. So we've thrown out bigger numbers than even Gary in terms of our expectations, but that's not tomorrow, next week, or next month. And we actually have a slight reservation that for a period we may get a short rally on the dollar. When I refer to the gold charts, I'll show you that we've had a bit of a fizzle back. There's small amount of resistance. So I must finish here, but we've made an HVF technical target on the daily pattern. We've made a weekly HVF method target on the platinum, which was also part of a big breakout. And silver is in the $45-50 range, which is a potential, doesn't have to be, but a potential typical technical resistance range that has been shown to be won twice before. And the dollar index has come back to a key funnel and channel range up on the big time frame charts. We might get a small rally before maybe breaking it to the downside. So we're at a technical place where there could be a little bit more gestation, and I'd point to the data coming on Friday maybe being a driver for that. I'll start with gold because of the correlation with gold and silver. This is our structural technical setup. That was a continuation pattern that broke, that delivered the target here. We had a moderate pullback and we've been squeezing up in a rising wedge. I'll just point out that this is a daily chart, by the way, so that's the D for daily. You're getting a little bit of a shooting star here, candlesticks, a bit more rejection here in a constriction, which typically can set up some of that correction that Gary was alluding to technically that can come. That's where our position is, that we're overdue slightly, somewhat on a smaller time frame. Your question started on silver, however, and I want to answer that. And in the more broad macro terms, we're exceedingly bullish that we've been quoted in the Jerusalem Post at our $330 call. This is based on an article that we've done, and I will give you justification for that now in a minute, just so that you know how aggressively bullish we are in the precious metal space. This is also more of a statement about the degree of depreciation of the dollar. I'm afraid it's a hard dollar narrative that goes hand in hand in that, and a commodity overall bull. So it should be quite concerning to everybody. Just on the macro, the silver, the real breakout in nominal terms for silver has not actually officially even begun yet on the quarterly basis, because many people are using the cup and handle reference. It is a technical reference, and I do occasionally use it. We actually have a better mechanism for naming and targeting out of that. But if I just bring that up, so that everyone can see it, I'll just remove some of the lines just so you can see a clean chart. In truth, we're getting to the gateway of the real show. This is all the warm-up show. You know, you watched XYZ band and another band, and you're waiting for the U2 or the main band to actually come onto the stage. We are just getting to a point for a quarter where we've attained a quarter close that is higher than the previous quarter closes here. So this is a 3-month chart when I say a quarter. So the breakout of the cup and handle at a quarterly close level has happened. Previously, you got rejections. Yes, you got close to 50 on both times, tiny bit more so over here. We've held on to a lot more, but it might be a logical place for what's sometimes known as the return move. The fun part starts and the real breakout for us starts for silver once any technical correction might occur at these levels in and around. I've highlighted that gold shooting star rising wedge after running its 3,770 target we provided. It has traded in the 3,800s, but it's had now $70 rejections in that range, bigger scaled rejections. We might get that little bit more, day or two, 3, 4, who knows, pullbacks, and that could allow for that silver. The move you don't want to miss, and the entry you don't want to miss, which will be the last chance sub $50, is in this period here, if that occurs as I expect, because that's when we go face meltingly fast.
Yes, we have a long ways to go. I'm on record. $10,000 is going to be a piece of cake. Now there'll be some scary pullbacks along the way. So a piece of cake doesn't mean it's going to be easy, but we're going to get there. Now we're in the advancing phase of a new intermediate cycle. I think that still has further to run. So overbought doesn't really mean the same thing when you're in the advancing phase of an intermediate cycle as it does when you're in the declining phase. So if you're in the declining phase of an intermediate cycle, when you get overbought, then usually what happens is you turn back down pretty quickly. But in the advancing phase, which is where gold and silver are at right now, what tends to happen is you get embedded in the overbought condition, or you get really heavily overbought. Like RSI, I tend to watch like the 5-day RSI, but that might embed for several weeks, or it could go to say like 95 on the RSI before you get some kind of a pullback. And that's one of the indications that you're in the advancing phase of an intermediate cycle, is that RSI it gets heavily overbought and it tends to embed in the overbought condition. So that's not typically a warning sign by itself, just an overbought condition.
Regarding the current gold cycle, FrancisHunt believes the market is still in its early phase, despite strong gains. He argues that falling energy prices and understated inflation are boosting miners' profitability, setting the stage for a powerful upside. With miners deeply undervalued and the dollar's long-term weakness intact, Hunt sees this environment as a rare opportunity before gold enters its next parabolic rise. Gold hit a record high on Tuesday as a U.S. government shutdown persisted and expectations for a Fed rate cut this month boosted demand. While gold miners had lagged the bullion in recent years due to rising costs and operational setbacks, they have outperformed in 2025 as record prices boost profits and cash flows, strengthening balance sheets and offering leveraged exposure to the gold rally. From GarySavage's perspective, the U.S. isn't yet in recession. Low oil prices have delayed the typical catalyst. He sees the bull market continuing as AI and robotics mature, but warns that rising geopolitical tensions could eventually trigger a cyclical downturn. Let's get back to the interview.
So I'll start off with a fundamental comment. It's incredibly early, despite what it's already done, is my overarching feeling. That can be supported technically, which I'll do in a minute. Something you have to bear in mind is that essentially we've been costs are in a recession. You've got energy down, which is something we've focused, oil price. So from the last 2 years, we're actually long leveraged gold, and we did a commodity neutral trade, short oil, which reflects the weakness of the general economy recession. So people aren't ordering things on Amazon to the same degree. There's no delivery taking place. There's less travel. There's less business holidays, leisure holidays, whatever the case, going on. And actually oil is quite suppressed at the moment, generally, given the true CPI, which I don't think you're getting real numbers for. So we called the lie on labor numbers. That's largely been exposed for the last 3 years. We've said there's no way you weren't in a recession. They said in the US that no, employment is so strong, and now we've seen the larger lie of that unravel. So non-farm payrolls is a particularly flawed number, and they based I'm going right back to Biden and Yellen regime with that. I think the CPI will be the next lie that will be exposed. on a great degree that it's not reflecting it, which is why you're getting these high GDP numbers, because they're not being re-rated in real terms sufficiently for inflation. So the next lie in the propaganda of economic stats that will be exposed, in my opinion, is CPI. So you're facing a lot higher inflation. So the oil price actually still being in the 60s when we shorted it at the 84 has added alpha to our dollar long, while giving you reduced risk if the whole commodity complex had collapsed, or if you'd had high inflation and it had all moved up. So you would have reduced your risk, and you would have made additional alpha on your gold long with that. And we had an inverted head and shoulder on that. So that is the gift to miners, because it takes energy to dig holes in the ground, part of the big cost. So they've got recessional costs, and they've got an absolute parabola in play on the top line. So imagine you're in a business that has been hated for decades, hasn't had much capital formation or interest from the Wall Street brigades. You now enter into a cash flow generation hemorrhage, where actually your costs are not re-rating upside. Your oil prices have actually gone down in an environment that is probably more inflationary than is truly stated. And your top line is going into a steady parabola, where most of the accountants conservatively, not so long ago, were working on $1,800 oils and $1,800 gold and $2,000 gold, now find you knocking on the door than more than double of that. So miners, wow, the multiplier effect, there's going to be face melting. And that's why I think Gary's not finding the pullbacks coming in, because it's just been so ignored, and it's still relatively such great value to true cash generation. So when we look at especially the NASDAQ divided by, say, the silver junior miners, that would be a very extreme chart of great interest I would put forward, just to show you how early everything is. And I'm tempted to bring it up. I'm just trying to bring in a dollar index chart to make sure that I'm not being misconstrued. I'm not a dollar bull. I'm just talking about a minor at most technical potential rally roundabout now, with a non-farm number coming in. Just that will permit. This is the bigger channel. I actually think this channel fails as part of dollar debasement, but I just wanted to highlight it. You can see the gray line and the dashed line.
Now, we could be in for a cyclical bear market, not a secular bear market, maybe a cyclical one if we have a recession. But I am not in the camp that we are in recession right now, not yet. They don't just appear magically out of nowhere. There has to be a catalyst to have a recession. Unless you just do something stupid like closing down the world for a virus. Generally, what causes a recession is the price of oil spikes. Rule of thumb, 100% or more in a year or less. That's just too much of a shock to the economy. It collapses the discretionary spending of the lower class and the middle class, and then that causes the spiral down. Businesses aren't bringing in as much money, and they start laying off employees, and they can't buy stuff. But other than that, or just doing something stupid and a self-inflicted recession, there has to be a catalyst for a recession. We don't have one yet. Oil is low, and it's been low for months and months, for a year or more. So that catalyst that generally causes recessions not here yet. I also don't think that this rally in the stock market has gone nearly far enough. The last two secular bull markets lasted between 20 and 25 years. We're what are we, 16 years in? The Dow went up 20 times in both of those, at least 20 times. I haven't done the Dow, but the S&P, last time I looked, was only up about 9 times. AI is still in its infancy stage. I don't see that it's gotten to the point where every Tom, Dick, and Harry is bragging about how much money he's making in AI stocks that have no hope of ever turning a profit. So we're still in the infancy stage of that, and robotics, another paradigm shift in technology. I think those have to get a lot more mature. I think the saturation has to get to the point where we're just doing stupid things with companies that have no chance of making money. We're not there yet. Also, at the 2000 top, I think the NASDAQ was stretched I want to say about 60% above its 200-day moving average. It's a sign of a bubble.
In the early months of the gold bull rally, gold stocks lagged, but they have played catch-up in recent months. Silver's inflation-adjusted all-time high would translate to over $150 per ounce in current dollars, suggesting significant upside potential if historical patterns repeat. This context helps explain why some technical analysts believe that, despite recent gains, silver remains severely undervalued relative to historical precedents. As the cracks in the global financial system grow wider, will you be prepared before the shift happens or after the damage is done? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.